Okay, so you want to own a real estate business. You've seen the custom highway billboards glowing at midnight. You've watched top producing agents coast into suburban driveways in six-figure German sedans. You've listened to late-night podcasts featuring self-proclaimed moguls who bought a handful of rental properties in their 20s and retired by 40. And somewhere in the back of your mind, sitting at your desk, you've been doing the math. A 5% commission on a $750,000 home yields $37,500. Close just 2 of those a month, and you're pulling in nearly $1 million a year in gross revenue. It sounds like the closest thing to a legalized license to print money in North America. Here is the brutal, unvarnished problem. The back-of-the-napkin math most people are doing is not slightly off. It is completely, utterly, and catastrophically wrong. Because what you see from the outside of the real estate industry, the glossy Instagram listings, the ribbon-cutting ceremonies, and the headline transaction volume, has almost zero mathematical connection to what the business actually looks like from the operational inside. The vast chasm between retail perception and balance sheet reality is precisely where 90% of newly licensed brokerages die a quiet, expensive death. They don't go broke because the underlying asset class failed. They go broke because they mistook a high-volume, capital-intensive customer acquisition machine for a passive luxury lifestyle business. So, let's tear this machine down piece by piece, the way an institutional operator sees it, not the way it's pitch-decked to ambitious rookies. Before we spend a single dollar, we need to establish absolute clarity on what a real estate business actually is, because real estate is not a singular enterprise. It is an umbrella collection of at least 7 distinct sub-industries, each governed by completely different capital requirements, regulatory hurdles, risk profiles, and margin structures. The first model is the traditional sales brokerage. This is an agency model where you contract with licensed independent sales agents to represent buyers and sellers. The brokerage collects a split of every earned commission. It requires relatively low initial physical asset capital, but produces extraordinarily volatile transaction-dependent cash flow. The second model is direct property investment. You acquire physical land and structures, hold them on your corporate balance sheet, and wait for long-term equity appreciation, while tenant rental payments service your debt amortizations. The third model is third-party property management. You don't own the underlying dirt or concrete. You operate the infrastructure for institutional or private landlords. You collect rent, handle midnight emergency plumbing breakdowns, execute tenant screenings, and invoice the property owner a monthly management percentage. This is the highest margin, most defensive, recurring income engine in the entire asset class. The fourth model is ground-up real estate development. You acquire raw land or distressed structures, navigate zoning overlays, secure municipal approvals, pour concrete, and sell or lease the finished product. This is where multi-million-dollar fortunes are created and where legendary bankruptcies are signed. Then you have wholesaling, speculative house flipping, and high-yield rental portfolio aggregation. Each operates on radically different unit economics. Each will liquidate your capital reserves in a completely unique way if you enter without understanding the underlying math. Most entrepreneurs who say they want to start a real estate company mean they want to launch a sales brokerage. So, that is where our autopsy begins. But by the end of this breakdown, you will understand why the smartest operators in modern finance eventually use sales brokerages merely as cash flow feeders to fund direct asset ownership. Let's step into the shoes of a founder launching a mid-tier commercial brokerage in a competitive metro market. Before you can legally collect a single dime in commission, the regulatory and capital meter starts ticking at maximum velocity. First comes regulatory compliance and corporate licensing. You must hold an active principal broker's license, satisfy state education requirements, pay examination fees, and execute formal corporate entity registrations. Right behind that is errors and omissions insurance, the legal defense armor required when a buyer discovers structural foundation defects and names your firm in a multi-party lawsuit. Next is physical real estate overhead. While internet gurus preach the gospel of virtual brokerages, Institutional clients and high-producing agents demand physical presence. A visible, professional office space in a primary commercial corridor requires multi-year lease commitments, tenant improvements, high-end interior build-outs, and ongoing facility utilities. Then comes the modern enterprise technology stack. You need an enterprise customer relationship management engine to track tens of thousands of cold leads. You need high-speed data feed integration to stream active property databases onto your custom web portal. You need transaction management platforms, digital signature infrastructure, encrypted document vaults, and cloud accounting software. Layer on top of that your initial brand launch campaigns, digital search advertising, local physical signage, high-production corporate video assets, and targeted direct mail drops. Before a single client signs an exclusive listing contract, your launch capitalization easily burns through tens of thousands of dollars in pure cash outlay. And here is the structural trap that destroys most early-stage operations: the brutal real estate sales cycle. In residential and commercial real estate, the average duration between the initial contact with a client and the actual clearing of a commission check ranges from 6 to 12 months. That means every dollar spent on Google search ads or local marketing in January will not produce a realized dollar of gross revenue until October or November if the deal doesn't collapse during escrow. Meanwhile, your commercial rent, software licenses, legal retainers, and administrative salaries must be paid in cash on the first day of every single month. This severe structural cash flow mismatch creates a financial valley of death. Brokerages do not fail because their business model is fundamentally flawed. They fail because their working capital exhausts itself before their pipeline matures. Compounding this operational cash burn is the brutal physics of customer acquisition cost in a hyper-saturated market. Real estate brokerage is one of the most overcrowded service sectors in the modern economy. In almost every major metropolitan area, thousands of licensed agents and hundreds of boutique brokerages are desperately fighting for the exact same pool of home sellers and property buyers. This extreme saturation drives digital advertising economics to eye-watering levels. In prime markets, competing for high-intent Google search keywords forces brokerages to pay extraordinarily high rates for every single user click. Now, consider the mathematical conversion funnel. Out of every 100 prospective buyers or sellers who land on your digital portal, only 1 or 2 will ever leave their contact information. Out of those qualified leads, only a tiny fraction will convert into a closed, commission-generating transaction after months of persistent phone calls, automated email nurture tracks, and physical property tours. When you run the fully loaded acquisition math, acquiring a single paying listing or buying client through paid digital media regularly costs hundreds, if not thousands of dollars in direct ad spend. On top of this customer acquisition penalty, every newly established brokerage collides directly with what Wall Street calls the trust deficit. When a family or a commercial investor is preparing to commit the largest single financial transaction of their life, they do not select an unproven startup that opened its doors 6 months ago. They default to institutional legacy brands, the multi-generational firms whose yard signs have littered suburban neighborhoods for 30 years, the global franchises backed by massive national television budgets, or the dominant local teams who hold multi-decade relationships. Overcoming this entrenched trust barrier requires sustained, multi-year capital deployment into local brand building. A new brokerage must maintain aggressive marketing outlays month after month while simultaneously paying fixed operational overhead, forcing the founder to underwrite deep operational losses until brand equity takes root. If a brokerage manages to survive the initial cash burn, how does it actually generate defensive, enterprise-grade cash flow? The most durable companies do not rely solely on property sales. They build a diversified ecosystem of complementary revenue streams. The first and most visible stream is the sales commission split. When a transaction closes, the gross commission is collected by the brokerage and divided between the firm and the operating agent based on a contractual split agreement. However, out of the firm's retained portion, the brokerage must fund national franchise royalty fees, transaction coordinator overhead, office facility allocations, and marketing support. Net margins on transaction splits are shockingly slim. The second stream is tenant placement fees. When property owners need qualified tenants for residential or commercial units, the brokerage handles property marketing, applicant background checks, credit evaluations, and lease execution. The standard market compensation equals a full first month's contract rent, providing rapid, high-margin cash flow with zero long-term maintenance liability. The third, and by far the most critical stream, is third-party property management fees. A scaled property management division charges property owners a continuous percentage of gross monthly collected rents to oversee day-to-day operations, vendor coordination, rent collection, and lease enforcement. Unlike sales commissions, which drop to absolute zero during housing market downturns, property management fees arrive on the first of every month with clockwork precision. Tenants must pay rent regardless of macroeconomic volatility, credit market freezes, or prevailing interest rates. A brokerage maintaining a robust portfolio of managed units generates a predictable cash flow base that fully covers fixed operational overhead. Beyond these core pillars sit ancillary business lines, cross-market referral fees, commercial leasing advisory retainers, land developer representation contracts, and direct asset syndication fees. The operators who build multi-million-dollar real estate platforms structure their businesses so that transaction market slowdowns simply allow them to lean harder into property management and asset acquisition. To understand why real estate brokerages operate on razor-thin net margins, let's trace the forensic movement of money inside a single standard residential transaction. Imagine a single-family home sells for $500,000 in a typical market. To the untrained eye, it looks as though a massive pile of wealth has changed hands. But the moment the escrow officer executes the transaction, that capital instantly splinters across a complex institutional chain before anyone sees a single dollar of net profit. First, the seller's existing institutional bank mortgage is completely paid off. That cash flows directly back to Wall Street balance sheets. Next, state and local governments collect real estate transfer taxes and municipal recording fees. Then comes the professional service layer. Title insurance companies collect their policy premiums to guarantee clean legal title. Settlement attorneys invoice their closing fees. Independent appraisers, property inspectors, structural engineers, staging companies, architectural photographers, and repair contractors all collect their fixed cash fees before the seller receives a single check. Now look at the remaining gross commission pool. That gross amount is split between the listing brokerage representing the seller and the cooperating brokerage representing the buyer. Let's follow the listing brokerage's portion. Out of that gross check, the brokerage retains its contractual percentage split and disperses the remainder to the individual sales agent. From the brokerage's retained piece, corporate franchise royalties are instantly deducted. The remaining capital must go toward paying fixed office rent, administrative staff payroll, software licenses, legal retainers, and marketing overhead. The actual net profit staying on the brokerage balance sheet on that entire transaction is often a tiny fraction of the headline sale price. Now look at the individual agent's side. Out of their earned split, they must personally fund the high-definition photography, aerial drone video production, targeted digital advertising campaigns, physical open house staging, client transportation, and professional license renewals. Once self-employment taxes, federal income taxes, and healthcare overhead are paid, the agent's actual take-home pay on a $500,000 transaction represents less than 1% of the total property value. This is not an industry where individuals effortlessly print fortunes. It is an unforgiving manufacturing assembly line that converts massive gross volume into paper-thin net margins. There is a pervasive, seductive myth among new real estate entrepreneurs that targeting the ultra-luxury market is the fastest shortcut to generational wealth. The logic seems flawless. Why close 20 average family homes when you can sell one $10 million waterfront estate and make the exact same gross commission? In reality, the luxury market is a capital-intensive financial trap for undercapitalized operators. First, consider listing velocity and carrying costs. Ultra-luxury properties routinely experience high days-on-market averages. Highly bespoke multi-million-dollar estates can sit on the market for 6 months, a year, or even longer before finding a qualified buyer whose tastes align with the property's custom architecture. In stark contrast, mid-market homes priced at median regional values turn over rapidly. In high-demand suburban nodes, properly priced mid-market inventory sells in a matter of weeks. This velocity gap is fatal because the holding and marketing costs of a luxury listing are astronomical. Marketing a $10 million estate requires custom architectural cinema production, targeted international print spreads, private preview events complete with security detail, high-end interior staging rentals running month after month, and specialized legal oversight. A single luxury listing marketing budget can easily burn through tens of thousands of dollars long before a purchase contract is inked. Furthermore, ultra-high net worth buyers are extraordinarily sensitive to macroeconomic sentiment, global stock market volatility, and tax policy changes. When global financial markets become volatile, luxury buyers simply pause. They feel no structural urgency to move. The luxury market can freeze instantly. Meanwhile, the mid-market housing engine moves continuously throughout the economic cycle. Mid-market transactions are driven by unyielding human life events, job relocations, marriage, divorce, expanding families, downsizing retirees, and corporate transfers. These buyers cannot wait 2 years for interest rates or equity markets to adjust. Consistent transaction velocity and operational predictability will beat headline commission numbers every single time. Because customer acquisition via paid channels is so punishingly expensive, the long-term survival of a real estate agency hinges entirely on a single operational objective: escaping the paid ad trap and building a self-sustaining referral flywheel. In the early years of a brokerage, every single transaction is acquired through sheer cash burn paid search, social media campaigns, physical mailers, and cold prospecting. The acquisition cost per client eats up a massive portion of the gross split. However, as an agency matures and executes flawlessly over time, the underlying unit economics shift dramatically. Institutional industry data demonstrates that veteran agents and established brokerages with over 15 years in market derive nearly 70% of their annual transaction volume from past clients and direct word of mouth. Referrals. A referral client arrives with pre-built trust. They don't require 6 months of aggressive digital nurturing, they don't demand discount commission structures, and their acquisition cost is essentially $0. When your acquisition cost collapses to zero, the gross split retained by the brokerage transforms almost entirely into net operating margin. This creates a powerful compounding moat. The new brokerage, spending thousands of dollars to capture cold leads on Google, cannot mathematically compete with an established firm whose deal flow arrives organically via client advocacy. The legacy firm can afford to reinvest its profits into superior technology, elite staff, and client experiences, widening the competitive gap year after year. Even a brokerage with solid transaction volume can be quietly gutted by a constant parade of parasitic fixed costs and operational leakage. These overhead line items operate silently in the background, consuming cash reserves during market contractions. Commercial office leases do not care if local home sales drop by 40%. Enterprise CRM subscriptions, MLS database access fees, administrative payroll, and liability insurance premiums bill with absolute regularity on the first day of every month regardless of market activity. For a mid-sized commercial or residential agency, fixed monthly overhead easily runs into tens of thousands of dollars before a single deal is closed. Then comes the most painful operational leak in the entire real estate industry: failed deal attrition. A real estate purchase agreement is a fragile legal instrument, laden with legal contingency clauses. A transaction can collapse at any moment during the escrow window. A home inspector discovers unpermitted structural alterations or environmental contamination. An appraisal report comes back below the contract purchase price, causing mortgage underwriters to deny financing. A buyer experiences sudden employment termination or a credit score change. When a transaction collapses after 30 or 45 days of intensive coordination, the brokerage collects $0 in gross commission. But the capital already spent on professional photography, staging, paid advertising, administrative processing time, and legal reviews is permanently gone. Every failed deal is a pure cash loss. In volatile economic environments, contract failure rates can reach 20 to 30% of all written escrow agreements, representing a massive drain on operational liquidity. Add to this the ongoing threat of legal litigation. In a business centered around the transfer of multi-$100,000 physical assets, disputes are an inevitable reality. Buyers alleging undisclosed property defects, sellers claiming breach of fiduciary duty, or tenant disputes all require immediate legal retainers. Defense legal fees can rapidly erase the profit margins of an entire quarter's worth of successful transactions. The risks inherent in real estate operations are deeply structural and inextricably tied to macro-monetary policy. The most lethal systemic threat to any real estate platform is an abrupt interest rate shock. Because the vast majority of residential and commercial property acquisitions are financed through debt leverage, any rapid increase in borrowing costs directly impacts consumer purchasing power. Consider the mathematical impact of interest rate movements on consumer affordability. When benchmark mortgage rates rise sharply, the monthly debt payment required to service a standard mortgage climbs dramatically. A buyer who could comfortably afford a $400,000 home at low interest rates suddenly finds themselves priced out of the market entirely when rates double. Same buyer, same property, same purchase price, but the monthly capital obligations skyrockets. This dynamic triggers the dreaded lock-in effect. Existing homeowners who secured ultra-low mortgage rates in previous years refuse to list their properties for sale, realizing that selling their current home means trading a low-cost mortgage for a high-cost debt structure on a replacement property. Housing inventory dries up, transaction velocity collapses, and brokerages that expanded aggressively during low-rate market booms suddenly find themselves burdened with massive corporate overhead and dramatically reduced transaction volume. Speculative business models like speculative house flipping face brutal margin compression during these rate cycles. Flippers who acquire distressed properties using short-term high-interest debt leverage find their profit margins completely wiped out when holding costs escalate and final end buyer sale prices soften. When debt costs rise, unprepared operators are exposed instantly. As if macroeconomic volatility were not enough, the real estate industry is currently experiencing the most aggressive technological transformation in its history. Artificial intelligence, automated property valuation algorithms, and machine learning platforms are systematically dismantling legacy operational workflows. Machine learning algorithms can now ingest thousands of regional data points, historical sales trends, tax assessment records, school district performance metrics, transit infrastructure investments, zoning modifications, and hyperlocal crime statistics to generate predictive valuation models with breathtaking precision. Automated CRM engines track user browsing behavior across web applications, automatically triggering personalized, algorithmically timed outreach campaigns without human intervention. AI assistants handle preliminary client inquiries 24 hours a day, qualifying leads, gathering financial pre-approval documentation, and scheduling property viewings seamlessly. In modern property management operations, Internet of Things sensors installed in commercial HVAC systems, plumbing networks, and electrical panels detect mechanical anomalies before catastrophic failure occurs, automatically issuing work orders to subcontractors without a property manager ever picking up a phone. The economic consequences of this technological shift are profound. Traditional entry-level administrative positions, junior leasing assistants, document processors, manual data enterers, and basic customer support staff are being permanently phased out. The firms that survive and dominate the next decade will be lean, tech-enabled platforms that utilize automation to drastically depress fixed operational overhead while delivering high-touch, institutional-grade service at scale. How do the world's largest real estate companies escape the transactional hamster wheel and build billion-dollar enterprise valuations? They execute one fundamental strategic pivot. They stop selling labor and start monetizing systems. Traditional local brokerages operate on a linear model. An agent closes a transaction, the firm takes a split, the deal finishes, and income drops back to zero. Growth is mathematically constrained by the physical capacity of local human labor. Global enterprise brands like Keller Williams and CBRE Max do not rely on local transaction closings to fund corporate operations. They operate as global system franchisors. They license their brand identity, technology platforms, training systems, and operational playbooks to independent regional franchise owners. In exchange, they collect fixed monthly technology fees, regional desk fees, and percentage royalty cuts from hundreds of thousands of agents across global networks, regardless of whether any individual agent closes a home on a given Tuesday. At the apex of institutional commercial real estate, megacorporations like CBRE Group and Jones Lang LaSalle operate multi-billion-dollar global workplace solutions divisions. They enter multi-year facility management and portfolio administration contracts with multinational corporations to manage millions of square feet of global office space. These institutional contracts produce predictable, contractual recurring revenue month after month, completely insulating the enterprise balance sheet from residential housing cycles. They built real estate empires by transforming volatile real estate transactions into predictable, subscription-like financial infrastructure. This brings us back to our foundational question: should you actually open a real estate business? If your motivation is fueled by late-night social media videos, romantic visions of driving luxury vehicles, or the mistaken belief that selling real estate is an easy pathway to passive wealth, the financial reality is stacked overwhelmingly against you. The sales brokerage business is an unforgiving, high-overhead, low-margin customer acquisition engine that will rapidly consume your working capital if you enter undercapitalized or unprepared for market volatility. However, if you approach this industry not as a luxury sales agent, but as an institutional operator, if you enter with deep cash reserves designed to survive the initial cash burn cycle, if you aggressively build recurring property management fee streams to offset fixed overhead, if you leverage cutting-edge automation technology to compress operational costs, and, most importantly, if you use your brokerage platform as a cash flow funnel to systematically acquire direct physical real estate assets on your own balance sheet, then real estate remains one of the most powerful wealth creation engines in modern history. The ultimate fortunes in this business are not created by simply executing contracts for commission splits. They are created by mastering the underlying unit economics of the enterprise, building defensive systems, and using those systems to acquire real estate assets that pay you long after the final deal is closed.